Federal Reserve Chair Jerome Powell testifying before Congress on Tuesday and saying it is still too early to tell if the coronavirus will have a persistent impact on the U.S. economy. So what does this mean for monetary policy? Look who's back. Peter Hugg, Global Trading Director of Kitco Metals. Pete, we missed you. Welcome back to the show.
Good to be here again, Daniela.
So let's start with how the markets are interpreting Powell's messages today, and more importantly, how you are interpreting it. Right now, as you talk, stocks are still up, gold is still down.
Well, I mean, I think Powell made it fairly clear that at least in the immediate term, he's happy with the way the economy is moving. He's happy with the employment gains. He's happy with household formation, and he thinks the economy is in a relatively strong place. And if you take the coronavirus issue off the table, that would indicate that the Fed is probably going to be standing pat on interest rates, probably until at least through the spring. Look at it again early summer. But right now, I think the Fed has basically made a statement that they are comfortable with where rates are and no immediate need to drop rates, barring any development from potentially the coronavirus, which he did bring up as a potential threat.
Okay, so, that said, Pete, how do you think that will impact gold prices going forward now? Well,
again, difficult to say when you use the context of going forward. I think in the short term, I think gold is a difficult metal to call at these levels right now. I don't think the Fed is going to drop rates in the short term, but I do think that there could be other risks to the Fed policy, and that would obviously be if the U.S. stock market started to sell off significantly. By significantly, I don't mean a 3 or 5% correction. So right now, gold is right in sort of a neutral area. I'd like to see gold close over the 1578 level, and if we got that close, I think 1600 would be the next move. On the downside, I'm looking for gold to hold the 1550 level. But in the interim, there's very little movement here in the gold market from the perspective of investor interest. It's been trading in about a $20 range with very, very little volume from the retail investor side. I'd like to see that pick up. The upside to that comment is that retail investors are not selling into strength, which is something that they have been doing. So they're willing to hold pat and sort of watch this market. So right now, it's right in the middle. I mean, and again, it's not a good thing when you ask an analyst which way is the gold market going to go, and he's going to say he doesn't know. And quite frankly, right now, I don't know. I think it could tip either way at these levels. I'm still leaning that the market is constructive and will go higher, but I think it will take a catalyst to move it up through the 1575 range.
Let me ask you this, Pete. Do you believe in the rally that we're seeing in U.S. equities, or do you feel that it's just masking underlying problems in the U.S. economy? Do you believe the story, the narrative here?
Well, I think there's a lot of liquidity in the market, and the Fed with their repos are adding increased liquidity to the market. It's really a matter of where do you want to deploy your capital. I mean, interest rates globally are still at relatively all-time lows. The 10-year bond in the U.S. is yielding 1.6 right now. So, I mean, it's a matter of where this cash goes. And right now, the U.S. market is still the hot market. I mean, earnings have been relatively okay. First quarter GDP is looking to come in probably just north of 2%. So everything is still sort of moving along. If the question is, do I think the market is overextended and could use a correction? Yes, absolutely. But again, it's a matter of where are you going to put your capital? And the equity market is still, I think, has got some legs probably through spring. And then I would be a bit more concerned about the strength of the rally, especially coming into an election year. I think there's going to be a number of issues that develop a lot of them cannot be identified yet between now and November. And I think that's going to have an impact on the equity market, at least from a correction perspective. And I think that will end up being positive for the metals through the balance of the year. Short term, well, I'm neutral on gold, however.
Outside of the gold space, let's get your thoughts on the PGMs, rhodium. Still on a tear here. How do you see the platinum, palladium, and rhodium market?
Again, a lot there is going to depend in the short term on how quickly China can get their manufacturing base revamped and restarted. I mean, China has been the primary buyer of the PGM space for the past 3 years. Rhodium has got large spreads on the wholesale basis, but it is north of $10,000 depending on what type of rhodium you're looking to sell. And again, if the Chinese, if this coronavirus continues to dampen the Chinese economy, I mean, they're expecting 0 GDP growth for China in the first quarter because of this issue. And if demand from the Chinese side at least sort of stops for the time being, I think at least rhodium and palladium may have seen an interim high. I don't think this market is going to collapse, but I think it needs to consolidate at these levels for the next leg higher. I think platinum anywhere in sort of the 950, south of 950, 950 range, I think is a good medium to longer term buy. I see it, my target on platinum by year end is 1200. So I'm still constructive to PGMs, but I think there's a pause in the demand cycle right now because of what's going on in China.
You know, the thing that's interesting about rhodium, if you track back its charts, Pete, every time it's hit its all-time highs, it signaled the end of the bull market.
Well, okay, but then you have to look at sort of the event when rhodium ran. I think it was in 2006, ran up to $10,000. But if you look at that chart, it really is basically just almost a straight move up to 10,000 and then a collapse back down to the $3,500 range, within a space of less than 2 weeks. So I don't consider that a chart. But I do believe that if the economies globally are impacted by China and they start to slow, and there is evidence that the global economies are going to slow at least second half of this year, that the demand, and that will be seen in the PGM demand sector and the industrial sector. And that's why I think you're not seeing silver reacting to the same level to the upside that you have seen with gold. I mean, gold, last time gold was at this level, silver was at $22 an ounce. It's indicating that the industrial side is sensing that there is a slowdown coming. So on that basis, if you say that rhodium spiked because we've had this accelerated growth and now it's going to sort of plateau, and if rhodium starts to come down, that would indicate car demand is coming down globally, and that would signal that the economies globally are slowing, which would have an impact on the industrial demand and directly on the PGMs.
Good thoughts from you today, Peter. Appreciate you coming on, and we'll see you soon.
It was nice to be here again, Danielle. Take care.
And thanks for watching. We will have much more for you, so be sure to stay tuned to Kitco News.